Today, however, I want to answer the question, why mutual funds? You guys hear me talk all the time about you should be putting money in your Roth, and in your Roth you should be investing in mutual funds. Well, there's a lot of different securities out there to invest in. There's CDs, money market accounts, bonds, stocks, real estate, metals, futures, crypto, the list goes on and on. So why is it that I keep recommending mutual funds? Well, without getting too bogged down in definitions and everything else, CDs and money markets are typically offer low rates of return. They were just designed to try to keep up with inflation, and in many cases they fall short of that, okay? Bonds offer a modest rate of return, but a bond is actually just kind of a loan that you're offering a municipality or a government, something of that nature. And so bonds, they offer a modest rate of return, but they're not great for what you're trying to achieve as far as long-term goals. So that leaves us with things like real estate. Now, real estate is good to invest in, and you can do very well. There's lots of people that have written books and all sorts of things on the subject. However, real estate can offer a huge outlay of capital, and sometimes some patience and some luck in order to start seeing returns on that investment. Stocks and futures allow you the chance to beat the market. However, futures are really fast-paced, and it takes a decent chunk of seed capital to get into. Your average individual typically doesn't have the time to be focused on futures plus futures deal in large quantities of individual things. So there can be some risks and things involved in that. However, it is something that can make you some money. So back to stocks. Now, stocks offer you the chance to beat the market, which means gives you a chance for a good rate of return on your investment. However, there's a potential for high risk and high reward. Your fate, if you're in individual stocks, is tied to the fate of each individual company. Mutual funds reduce the risk by pooling money and then investing across multiple vehicles and industries. That's what makes mutual funds so good. So if you're, like me, an individual that doesn't have time to be glued to the computer all day, watching to see what's happening with AT&T and what contracts they might have and what expansion plans they've got going on and what their CEO is up to and everything else, then mutual funds are a better choice. Because mutual funds can actually invest in 20 or 30 different stocks, plus some bonds, CDs, cash, even real estate, those kind of things. So a mutual fund can spread out the risk. See, when people talk about stocks, they tell you to diversify your portfolio. You may have heard that phrase before, okay? Well, the reason they tell you that is so that all of your eggs are not in one basket. Most of the time, you can only buy a few stocks. And so if all you have is AT&T stock, then as I've been saying, your fate is completely tied to AT&T. But if you're in a telecommunications portfolio, or a mutual fund rather, as if you're in a telecommunications mutual fund, well, then that is not just invested in AT&T, but also Comcast and Elon's Starlink service and any other things out there, even international things that aren't coming to mind right now for me. So the key with diversification, especially with stocks, is if one goes down, then the others might be up to mitigate your losses. If you've got 3 stocks and one takes a dump, you're hoping that the other 2 are holding their value or have gained something. Well, with mutual funds, they're doing the same thing. Mutual funds automatically diversify, which means they automatically reduce your risk, And so your risk, instead of being tied to the fate of a company, your risk is tied to the ebb and flow of the market itself. So it's systemic or market-wide. You might notice that there's a lot of talk whenever the stock market goes down about people panicking. Those people that are panicking are the people that are invested in just one stock. There are people that maybe the only investments they've got are through their employee stock purchase program. So, of course, they're freaking out. And others. Remember that mutual funds are made up of individual stocks, so it's somebody's job to manage those mutual funds. And if the markets are going down, then they're, of course, going to sell off one stock and buy a different stock that might be positioned to do a little bit better. So that's the advantage of mutual funds. They're professionally managed. Somebody else's neck is on the line. You don't have to sit there studying the thing. If the market looks like it's going to go down, then they know all the tricks to preserve the money that's there, all the gains and whatnot that they've worked so hard for, and to be able to take advantage of the market going back up, which it tends to do. The market is very, very cyclical. As a matter of fact, we're on a huge upswing right now. There's been a little hiccups in the market lately, but maybe that's something that I'll focus on in a future video, because I've got some things to say about that. Now, the last thing that I'm going to get into with regard to mutual funds is it oftentimes takes a low dollar initial investment in order to get into mutual funds as compared to buying individual stocks of all the companies that mutual fund is made up of. Okay, so if there's 30 companies, well, if each individual stock is $100, then that's $3,000 just for one share of each of those stocks. Or you can buy a mutual fund share for, say, $1,000 and be invested in all of those stocks, which means that as those companies do well, you get to take part in that. And if some of those companies do bad, well, then there's somebody who's freaking out for you, dropping those and picking up something else or moving money around. So I hope that explains a little bit why I'm such a big fan of mutual funds, especially if you're investing in a Roth, or if you are investing in a 401k through work, as opposed to individual stocks. One stock is a huge risk, huge reward potential. Mutual funds, low risk, pretty big reward potential. So that's the way you want to kind of look at those things. Guys, there is a lot of stuff to be taken into account when you're looking at investing, okay? I'm trying to give you bite-sized chunks is what I'm trying to do. But if you got questions, hit me with them. If I don't know the answer, I'll look it up for you. I'll try and get it to you, okay? Or maybe I can direct you to a source that will be able to better answer your question. Don't mind doing that at all. I'm not trying to be Mr. Know-It-All. I'm just trying to help you avoid the mistakes that I've made in the past so that you can do better than I've done financially. But as always, guys, any questions, leave them in the comments below this video. If you're watching on YouTube, you can always hit me with them here on Twitch. I keep my chat open whenever I'm streaming. And you can also send them to me at fustingfinance@gmail.com.